I want to talk to you how to avoid paying taxes on your RMDs, required minimum distributions. All right, let's talk about how to avoid paying taxes on your required minimum distributions. Now remember, when the Secure Act was passed a few years ago, that's when at age 72 is the new RMD age, required minimum distribution. If you have IRAs and 401ks, 403bs, TSPs, and so on, money that you have not paid taxes, qualified dollars you have not paid taxes on. So remember, when you made contributions into your retirement plans, you made those contributions, you get a tax deduction. Now when you're 72, again, that's when the IRS said they're patient long enough and you have to start taking a required minimum distribution. We did previous videos on this explaining the percentages. So if you are 72 years old this year, you have to take out 3.65% of what December 31st balance was last year. Okay? So how do you avoid paying taxes on that money? And people ask me all the time, when I take that money out, what is the taxes? And I said, well, it all depends on what your tax bracket is at. It's ordinary income tax bracket, so that's what it's at. So how do you avoid paying taxes? Well, for those who are giving to charities, there is an option, and we talked briefly about this, but not in detail on previous videos, which is called a QCD, Qualified Charitable Distribution. For those people who are giving money to charities, you have ability to make that money non-taxable on your RMDs. And let's just talk about how it works. First of all, to qualify, you have to be 70 and a half to do a QCD, have that money go to the charities. Now, I know RMDs don't start till 72, but you can start sending money directly to charities once you're 70 and a half or later. How this works is you can have the check written directly to the charity and give that money directly to the charity to meet the RMD. So let's say, for example, you pretend everybody has $1 million, and or you had $1 million last year, right? And they look at December 31st balance in the market. Obviously it's changed since then, but 3.65% is your RMD percentage, which means you have to take out $36,500. Now, you can have all or part of that money go directly to a charity. You can choose multiple charities if you wish. So let's just say you send half that money to charity. $18,250 goes to a charity of your choice, and then you actually take the $18,250 and use that as income. Well, that $18,250, as long as you make that check directly to the charity's name. It cannot be written out to your name and then you sign a check to the charity. It doesn't work that way. It has to be written directly to that charity and given to that charity. You can get the check and give it to the charity, but it has to be written out to the charity's name to qualify. You cannot just write a check out of your own checkbook to do so. That's going to be considered a contribution to a charity. That's different than a QCD. The nice thing is what happens on your tax returns is you don't have to claim that $18,250 as RMD income, because on your Form 1040, and you talk to your accountant on that, or if you do it online, you write QCD next to the amount that is taxable. That's the big piece, is having go directly to the charity. And the nice thing is when you have that money go directly to the charity, it does not count as income. Here's a problem with what happens as retirees are, you're debt-free. For a lot of you who are 72 and older, when you're taking your RMDs, or you're close to being debt-free, if you have a mortgage, hopefully you're in the back end of that mortgage and paying mostly principal and less interest. Most people are not itemizing their taxes anymore. And if you're not itemizing your taxes, why would it make sense to take that money, pay taxes on it, your RMD money, pay taxes on it, and then give to charity? And if you don't itemize, you're not going to get that benefit of giving to charity on your tax returns. So that's the huge benefit, is giving that money directly to charity counts as income of zero for you, and the charity still gets that as a tax deduction, which is great. So that is a huge benefit of that. A couple other rules that apply to QCDs: the maximum you can give is $100,000. Not too many people have RMDs over $100,000, but if you do have significant amounts, your RMDs are capped on the QCD side to $100,000 per year. And again, a couple of the other rules are you have to be at least 70 and a half to do so. It has to be made to an approved charity. It can't just be somebody who doesn't have a 501c3. It has to be an approved charity. And it has to be coming from an IRA as well. So here's another benefit of not having 401ks, 403bs, employer-sponsored plan retirement accounts. In those retirement years, we've talked about why not having those, but here's another reason, because you can only do a QCD from an IRA, not from a 401k, not from a 403b, and so on. It has to be an IRA already to do a qualified charitable distribution. For those who are giving to charities, take advantage of this. You don't have to send all your RMDs directly to the charity. If you want to, great. But it's going to keep your taxable income, adjusted gross income, lower because you're not adding those RMDs to your income, which will also help for those who are looking to do maybe Roth conversions. If you have your QCD money, your RMD money go for your QCDs directly to a charity, well, then you can do your Roth conversions after that if you choose so. So there's some definite benefits to doing a QCD for all or part of your RMDs.